Regional economic integration refers to agreements among neighboring countries to reduce trade barriers and encourage the free flow of goods, services, and resources. Examples of this is the European Union or EU and the North American Free Trade Agreement or NAFTA, which have shown both benefits such as lower prices, larger markets, and challenges like increased competition for producers. So, while integration promotes cooperation and economic growth, it also raises concerns about trade blocs like becoming too protective against outsiders. Okay? So, this report will discuss the benefits, cost, and global progress of regional economic integration as well as its impact on international business. Now, let's start first with the free trade area. This is one of the simplest form of integration, which is the free trade area, where member countries remove tariffs and trade restrictions among themselves, but each country still has the freedom to set its own policies towards non-members. A good example is the NAFTA or the North American Free Trade Agreement or the NAFTA. Okay, so that is the one of the best example for the free trade area. Another example is the European Free Trade Association or the EFTA. EFTA is made up of countries like Switzerland, Norway, Iceland, and Liechtenstein. Okay? Unlike the European Union, the EFTA focuses mainly on free trade without moving toward deeper political or economic union. So that's the difference between the European Union and the EFTA. Now, let's move forward for the levels of economic integration. So, there are several levels of economic integration depending on how far countries are willing to cooperate. So, number one is political union. What is political union? Political union is the highest level where countries unify their policies under one central government. Okay? Second one is the economic union, where members not only share a common market but also coordinate economic policies and often use a single currency, like the European Union with the euro. Okay? So, in economic union, isang currency lang ginagamit. Okay? So, third one is the common market, which allows a free movement of goods, services, capital, and labor among member states. Okay? So, this is the common nowadays, which is the common market. Okay? So, number four, and the last one, is the customs union, which is members remove barriers among themselves and also adopt a common external trade policy toward non-members. Okay? Now let's move forward for the cases for regional integration. So, supporters argue that regional integration increases trade, lowers consumer prices, boosts economic efficiency, and strengthens political cooperation. Okay? So, it also helps smaller countries compete in a globalized economy by being part of a larger market. Okay? So, that is what a lot of people argue about. Next is the case against regional integration. So, however, critics says that it can also bring problems. Okay? So, there are two main issues here. Okay? Number one is the trade creation and number two is the trade diversion. Trade creation is when trade shifts from a high-cost domestic producer to a low-cost producer within the region, which is a good example. Okay? While trade diversion naman is when trade shifts from a more efficient producer outside the bloc to a less efficient one inside the bloc simply because the tariff advantage, which can be harmful for the business or firms. Okay? So, in conclusion, or in summary, regional economic integration can bring both opportunities and challenges. It benefits customers and promotes cooperation, but it also risks excluding non-members and creating imbalances.
The evolution of European Union. The European Union was established after the World War II, so ang goal ng pag-establish ng European Union is to foster peace, economic prosperity, and political stability. Second reason is the European nations wanted to hold their own on world's political and economic stage. So gusto nilang mag-build ng sarili nilang rules sa politics and sa kanilang economy. Ang European Coal and Steel Community ang forerunner ng European Union. This community was formed in 1951 by Belgium, France, West Germany, Luxembourg, Italy, and the Netherlands. So their objectives was to remove barriers to intragroup shipments of coal, iron, steel, and scrap metals. So they created an agreement which is called Treaty of Rome. So, ang goal ng Treaty of Rome is to eliminate trade barriers and create common external tariff. So, ang ibig sabihin is magsiset sila ng uniform tariff rate sa mga countries na part ng European Union. And also, they want to establish common policies in agriculture and transportation. So, noong 1973, nag-grow ang community na ito nung nag-join ang Great Britain, Ireland, and Denmark. And noong 1981 naman, nag-join ang Greece. Then, followed by Spain and Portugal in 1986. And many other countries joined in the following years, bringing the total number of members states of 27 with population of 500 million and GDP of 12 trillion. And mas malaki pa yung GDP nila compare sa United States. Next is the political structure of European Union. So the economic policies of European Union are formulated and implemented by a complex political structure. Unlike simple political systems, complex ones feature dispersed decision-making, a variety of actors and agencies, and higher degree of institutionalization, which enables them to manage large populations and diverse social and economic institutions. So, the four main institutions include the European Commission, the Council of European Union, the European Parliament, and the Court of Justice. Ang European Commission is ang executive body ng European Union. So they're the one who propose new laws and manages the EU policies, and they ensure that EU law is correctly applied. Next is the European Council. So they're the group of leaders from each European country that gets together to decide the EU's main goals and how to achieve them. So this includes the leaders like President and Prime Minister of European countries that is part of European Union. Ang European Parliament naman, sila yung elected representative ng each country na part ng European Union. So they come together to discuss decisions about laws that affect the entire European Union. So ang European Parliament is directly elected by EU citizen or EU voters every 5 years. The Court of Justice of European Union. So their role is to ensure that European law is interpreted and applied uniformly across all members of the state. So the Treaty of Lisbon updates the EU's operating system to make it run more smoothly, gives more power to the leaders, and it creates leadership roles. So this treaty also ensures that the basic rights of people within the European Union are protected. Next is the Single European Act. So the Single European Act was created because countries in Europe were not trading freely enough with each other, and the leaders wanted to make it easier to do business across borders. So to end this problem, the European Community business people created a campaign noong early 1980s para tapusin yung economic division na ito. So in response to the campaign of EC business people, they created the Delors Commission under the chairmanship of Jacques Delors. So this commission proposed that all impediments to the formation of a single market be eliminated by December 31, 1992. These are the following proposed changes of this act. First is to remove border checks between countries. Second, use mutual recognition for product standards. So, if one country approves a product, others should too. Third is to allow any country to bid on public projects to lower costs. Fourth is to make it easier to do banking and insurance across countries. Fifth is to remove limits on moving money between countries. And lastly, let truckers from one country deliver goods in another more easily. Single European Act made a big difference in the European economy. So, mas bumilis ang pag-grow ng mga businesses because they could sell their products and services more easily across different countries. This meant that company could make more money and hire more people. So, it also encouraged industries to to change and become more efficient, which helped the whole economy grow. However, even though Single European Act made things better, the market was not perfect and there was still some problems to solve. So, kagaya ng nabanggit ko kanina, ang Maastricht Treaty ang nag-create ng foundation ng European currency or ng euro. So, noong January 1999, ang European Community they adopted common currency which is called the euro. And the euro currency was now used by 17 of the 27 members of European Union. So, ang tawag sa 17 states na yun na nag-adopt ng euro currency ay Eurozone. Next is the benefits of euro. Euro allow people and businesses to save money because they don't have to pay fees to exchange currency when trading or traveling between Eurozone countries. Second thing is, it's easier to compare prices across Europe, leading to more competition and lower prices for consumers. Lastly, it make it easier for small companies to get investments. Next is the cost of euro. So the first disadvantage of establishment of euro is that countries lose some control over their own money policies because the European Central Bank or the ECB sets interest rates for the entire Eurozone. Second disadvantage is the euro might not be the best for all countries because their economies are different and single interest rate might not work for everyone. Lastly, euro put economic goals ahead of political unity. Since the euro started in 1999, it had its ups and downs. At first, it lost value compared to the dollar because investors were putting their money in the United States. However, later on, the euro got stronger as investors moved their money back to Europe. In 2011, the euro was still strong, but some countries in Europe had economic problems, which made things uncertain.
Now let's move on to enlargement of the European Union. Enlargement into Eastern Europe became possible after the collapse of communism. By the end of the 1990s, 13 countries applied to become EU members. This means that after communism ended, many countries in Eastern Europe wanted to join the EU for economic and political stability. Requirements for EU membership: first is privatize state assets, next deregulate markets, next restructure industries, next is tame inflation, next is enshrine human rights and democratic governance. These were the strict requirements for joining. Each country had to modernize its economy and protect democracy and human rights. In 2004, EU formally agreed to accept 10 new members, including the Baltic countries, Czech Republic, Hungary, and Poland. In 2007, Bulgaria and Romania joined. EU membership reached 27 nations. The EU grew very fast from 15 to 27 members in less than 10 years. EU now represented 450 million people. Single economy with GDP of 11 trillion euros, this made the EU one of the largest economic powers in the world. Next is the North American Free Trade Agreement or NAFTA, free trade agreement among United States, Canada, and Mexico. The goal of it is to eliminate tariffs on bilateral trade. NAFTA focuses on trade to remove barriers and allow goods, services, and investments to move freely across nations. NAFTA's content is first abolition of tariffs on 99% of goods traded, removal of most barriers on cross-border flow of services, protection of intellectual property rights, removal of restrictions on foreign direct investment, application of national environmental standards. These points explain exactly what NAFTA covered, not just goods but also services, investments, and even environmental protections. Supporters saw NAFTA as a win-win, cheaper costs for companies, more jobs in Mexico, and more exports to the US and Canada. While the opponents argued that NAFTA would hurt US workers, harm the environment, and give Mexico only low-paying jobs. NAFTA results. Trade between NAFTA partners grew by 250% in 1993 to 2005. Canada and Mexico became US top trade partners. Mexico's labor productivity increased by 50%. In reality, the results were mixed. NAFTA did increase trade and productivity, but its impact on jobs was smaller than expected.
So first, let's start from the Andean community. So Andean community was formed in 1969 by Bolivia, Chile, Ecuador, Colombia, and Peru. This is inspired the European Union model. So their goals is to reduce tariffs, create common market, and cooperate economically. But the problem by the mid-1980s, it almost collapsed due to political conflicts, economic crisis, and high inflation, and also lack of trust between the countries. In the 1990s, the group tried again and relaunched the Andean community, but progress was slow. Venezuela eventually left in 2006 to join another trade group. So next is the Andean Pact. Andean Pact, this is regional trade group na gusto mapag-isa ng economies ng Andean countries, which is the Bolivia, Chile, Colombia, Ecuador, and Peru. Pero nahirapan sila dahil sa political and economic instability. So ngayon, tinatawag na siyang Andean Community, pero compared sa Europe, hindi ganun successful. So next is Mercosur. So the purpose of this is create free trade and eventually a customs union. At first, trade between members grew quickly up to 80% increase. But the problems is the financial crisis in Brazil and Argentina, political disagreements, and recession slowed progress. So today, Mercosur is still important, but it hasn't fully become a customs like the EU. Next is the Central American Common Market. So this was formed in the 1960s by Costa Rica, El Salvador, Guatemala, Honduras, and Nicaragua. This is to make trade easier by reducing tariffs and creating a common market. However, in 1969, the group collapsed after a short war between Honduras and El Salvador. Later on, the idea was revived, and in 2005, a new agreement with the United States called CAFTA, or Central America Free Trade Agreement, was created to lower trade barriers and improve economic cooperation between the U.S. and Central American countries. For the next is the Central American Free Trade Agreement, or CAFTA. So CAFTA was signed in 2005 between the United States and 6 Central American countries, which is Costa Rica, El Salvador, Guatemala, Honduras, Nicaragua, and later the Dominican Republic. Its main goal was to lower tariffs and trade barriers, making it easier for goods and services to move between the U.S. and these countries, and also to strengthen economic ties in the region. So, next is the Caribbean Community, or CARICOM. So, CARICOM was created in 1973 by the group of Caribbean nations to promote economic cooperation and free trade among its members. In 2006, they launched the Caribbean Single Market and Economy, or CSME, which aimed to reduce trade barriers, allow the free movement of goods and services, and also the people, and make and make the economics stronger together. Next is the Caribbean Single Market and Economy, or CSME. So this was launched in 2006 under CARICOM. This was created to make the Caribbean region work more like a single economy by removing trade barriers and allowing the free movement of goods, services, capital, and skilled people among the members' countries, aiming to strengthen their unity and global competitiveness. So, for the next is the Association of Southeast Asian Nations. So, this was formed in 1967 by Indonesia, Malaysia, Philippines, Singapore, and Thailand. This is to promote peace, stability, and economic cooperation in the region. Over time, more countries joined. The ASEAN worked to create a free trade area, making it easier for Southeast Asian nations to trade, grow their economies, and strengthen regional unity.
Implications for managers. Regional integration gives business access to bigger markets and lower costs by producing and selling across member countries. This creates chances of efficiency and growth. However, it also brings challenges like tougher competition, cultural differences, and the need to adapt to different customer preferences. To succeed, firms must cut costs, stay flexible, and adjust their strategies in order to compete globally. Conclusion. Regional integration has both advantages and disadvantages. Its success depends on political stability, fairness among member countries, and strong institutions. For managers, this means they must adjust their strategies to stay competitive in an integrated market.